In this video, I'm going to share with you 5 steps that you can take to improve your investing skills after market crash or correction. The S&P 500, which is supposed to be a good proxy of the overall stock market in general, dropped by about 10% in the last couple of days. That technically puts it in correction territory. Now, that is just the average damage done to the stock market. If you want to get a sense of the real damage, just look at the tech stocks and the growth stocks, which were even worse. Then, of course, there's the cryptocurrency market, which has dropped by about 40% from its peak just 2 months back. And that equates to about $1.2 trillion worth of cryptocurrency assets that have been wiped out of existence. If you are a millennial or a Gen Z, then chances are that you have invested heavily in these two asset categories. And neither of them are doing well. So what's the question top of your mind? You're probably thinking, well, I have to do something to save my portfolio. After all, you can't just stand by the side and take a look at your portfolio, which is in deep red. Now, that is what triggers panic selling. And in this video, I'm going to talk about ways in which you can calm yourself down and also get something out of this experience. There are 5 steps that I'm going to talk about. Step 1, look at history and find strength to calm yourself down. The average time taken for the S&P 500 to bounce back from a bear market, which is defined as a drop of more than 20%, is about 2.5 years. I know that sounds pretty scary, but the good news is when the drop is only between 10 to 20%, in which case it's called a correction, and that seems to be the case right now, the S&P 500 has been able to bounce back in a pretty shorter time frame, about 3 to 6 months on average. And that's quite promising. As far as the crypto market is concerned, it's got a pretty short history, unlike the S&P 500, but still, it's been quite resilient even within that short history. It's after all bounced back every time it's fallen, and it has fallen multiple times. The advantage or the benefit of looking at historical data is that it helps avoid panic selling. Step 2, document your errors and exploits. I'm sure there are some smart moves that you made which worked out well for you. Then there are things that you'd like to avoid. Make an inventory of those experiences. Let me give you an example. I invested about 2 years back in a healthcare tech company, and it ended up being a profitable position for me in a short span of 6 months. But then it got acquired by a larger company, and that is when I should have revisited my analysis in the context of the larger company, and I didn't do that. I took the easy way out, which is no analysis and no decision. I just went with the flow, continued to stay invested. And what was a profitable position has now becoming a loss-making proposition for me. I don't see it recovering in the next couple of years, and that's something I would have loved to avoid. And that goes into my errors list. So you can make a similar list for your errors and exploits. And it's also a good idea to not just learn from your own experiences, but also what you've heard from your friends or what you've seen celebrity investors do if you've been following them on YouTube or any other media. Make a list of those as well. Step 3. Review your sources. There are 3 types of sources that you could come across. Ones that share only the data. These are quite harmless because they just share the data and they don't push their opinion on you. The onus is on you to take the data, do your analysis, and then come to your own conclusions about a certain investment decision. There are other types of sources which share only opinions. Just run away from those types of sources, as you could be misled without any solid rationale to back up that opinion. That's a no-brainer as well because it's easy to spot. Only opinions and no data. The most dangerous are the types of sources which share data as well as an opinion. Now, they could be right or they could be wrong. So you're at a disadvantage if you just blindly follow them. And the temptation is to take the easy way out, which is to follow them. So try to be very methodical about tapping such sources. Take their data by all means if you love the data, but be careful about taking somebody else's opinion. Still do your own research and form your own opinion. For example, whenever I see Mad Money on CNBC, I love the data they provide, but then I'm not a big fan of their opinions. Step 4, review investing style. There could be different approaches or styles of investing. Value investing, growth investing, dividend investing, or trading. And there could be many more. Then, of course, there is the diversified portfolio approach and the concentrated portfolio approach. Now, The question you want to ask yourself is your level of research and analysis before making an investing decision appropriate for your investing style? And is it taking you towards your goals or objectives for your investing journey? If not, consider either changing your investing style or improving your level of research to be in tune with your investing style. Step 5, and the last step, review investment types. As I mentioned at the beginning, if you're a millennial or a Gen Z, then stocks and cryptos are likely to be your most used investment types. Nothing wrong with that, but there are a number of other attractive investment options out there which you might want to explore. In fact, there are 8 of those which I think are primary investment types: cash instruments, bonds, equities, REITs or real estate based assets, commodities, currencies, derivatives, which includes options, futures, forwards, and even swaps, and finally funds, which include mutual funds, exchange traded funds, and index funds. It's very important that you familiarize with these different investment categories, maybe give it a try, and then you might still come back to stocks and cryptos. That's a different story. At least you familiarized and know the advantages and when to go for which investment type. To help you with that, I'm going to create one video in each of these investment types over the remainder of the week. So please be sure to hit subscribe. This is Senthil with the Game of Money, discussing investing, business, and careers.